All right, good evening, everybody, and welcome to Finom Group's latest video. As usual, I'm your host, Seth Golden, and might be out of practice, so bear with me, folks. We haven't done one of these videos in about a month. This video will be live for our premium and contributor members on Thursday evening. It will go public or to the general public over the weekend. So sit back. We're going to talk about, well, the history doesn't always repeat, but it often rhymes. We are at all-time highs, right? I mean, everybody's enjoying this bull market, at least those who are participating and haven't been trying to call the top in the market for what, the last for almost 5 months now, or since the first record high that was hit this year. We're going to get into some quantitative data as usual, look at some studies to see, where the market or what we should anticipate from the market going forward. Additionally, we're going to look at some colloquialisms. There's a lot of phrases that get thrown about the investor community, the markets, the economy. Most of them, it's literally nonsense. It means nothing. They lack all logic, but they either sound good or they sound intriguing, and they just catch fire, and they become like this mainstay around the market, dogma, if you will. With that, yours truly, if there is one thing, which shouldn't be hyphenated, but I did that on purpose. If there is one thing I've learned from the markets over my 24 years, it's that down is going to happen. Accept it for value opportunity, period. Don't try to stop it. Down is good. Down means you're able to buy low. When viewed any other way, the resulting outcome is usually down and out. I see far too many people trying to step in between the drawdowns in their portfolio and the drawdowns in the market by either, cashing out, raising tons of cash, hedging their portfolio, doing all kinds of undisciplined things for the sake of what they believe is risk management and taking lesser drawdowns. Doesn't work. It doesn't work. Oh, I know that people want it to work, and people still do it because it's just uncomfortable when your portfolio is going lower. But the reality is markets bounce back. More than likely, you're going to sell low and buy higher. Don't do that to yourself. Learn how to manage your cash wisely. Have a game plan. With that being said, looking at quantitative data. Now, a lot of the studies that you'll see public, thrown around in Twitter or on different Facebook groups, they'll have a headline, a title, if you will. One that we've looked at over the years is the January barometer. And this title, and this goes back to 2021, many of you have seen me go through this exercise time and time before. However, I'm bringing it up again because we have new ones, right? This is only basically looking at the January barometer. In many years, even though the January return was negative, the final 11 months of the year, almost always positive. Assuming, this basically assumes that the January barometer just isn't that accurate, right? The saying, the colloquialism, as January goes, so goes the year. This is what I mean by there's just not a lot of logic to these market colloquialisms when you put them to the test. Now, when we first looked at this, right, it looks very easy. These are years where January was down, but the market was positive in the final 11 months. And when you see the title, you kind of just take it for granted. This is what we're looking at. But something stuck out at me. In almost every piece of quantitative data, there's something obscure that you can read into, that you can find above and beyond what the title forces your eyes and mind to look at. And here's what I've noticed. Since 2008, down January, 9 down January, 10 down January. 3 negative Januaries in a row. And then it skips to 14. So what does that mean? 11, 12, and 13 were positive Januaries. So we had 3 down Januaries, followed by 3 up Januaries, followed by, yep, after 2013, 14, 15, and 16 were all negative. 3 down, 3 up, 3 down. I'm not throwing out gang signs, people. And then wouldn't you know it, it jumps all the way to 2020. So in between, you have 17, 18, and 19, all positive. 3 down, 3 up, 3 down, 3 up. Wouldn't you know it? 2020, 2021, and for those of you who know your market history, 2022, all red Januaries. The pattern is pretty clear. 3 down, 3 up, 3 down, 3 up, 3 down. So what do you think should happen in 2023? Exactly. 2023 was up. What happened in 2024? Up. If this pattern holds, 3 down, 3 up, 3 down, you get the point. 2025's January should be up as well. Now, you would have never guessed to look at that because, you know, the title just kind of forces you in one direction. It narrows your vision. But I can almost guarantee you every single piece of quantitative data or studies, you can extrapolate more than what they're trying to show you. Here's another example. And this is from Charlie Bolello. Here's his chart. It's just a simple S&P 500 index by year, every year since 1929, in the all-time highs. He's counting the all-time highs per calendar year. Number of all-time highs, 1929 to 2024. Right? That's what it tells you. It's just a tracking methodology. But can we find something more? I think we can. In fact, when we got to 11 all-time highs, you may have seen me put this out on Twitter. I know I told my Finom group members about this in our trading room, in our research report. As usual, if you don't get our research report, you got to subscribe to our contributor membership level or our premium membership level. Our contributors get all of our research, all of our videos, all third-party research disseminations. Premium memberships, you get all of our trades, all of our investment ideas. You can join me in the trading room daily, Monday through Friday. And we've got Telegram app communications going on all day with our premium members as well. With that, is there anything else? Well, when we got to 11, what do you notice about all the years? When there was more than one new all-time high in the calendar year, those are shaded in blue. There's no 11 here, right? There's no 11. No year where you had more than one had just 11. So what does that tell you, right? It basically tells you that there historically, if you got to 11, you are going to have at least, let's see, the fewest on here after you got to 11, it looks like 13. You're going to at least have 2 more new all-time closing basis highs. So fast forward to when we got to 17. That was last week. This past week, the S&P 500, this was in our research report, so I extrapolated it. That's why it's a paragraph form. This past week, the S&P 500 made its 17th all-time closing high of the calendar year. Given the aforementioned analysis surrounding all-time highs clustering in a calendar year, there has never been a calendar year that finished with just 17 all-time highs. So just like when we got to 11, we knew you would at least have 1 more or 2 more all-time highs. Oh, sorry, there's your 12. There's your 12. You would at least have 1 more new all-time high. Guess what? There were no 17s on here. So that told us you would at least have 1 more new all-time high. This is drawing more out of just a simple tracking methodology. You say, Seth, that's pretty, like you're trying to read into stuff. I'm not trying to read anything. That's what jumped out at me. It was like calling me, Seth, there's more to me than this. There's more than just tracking it by year. Remember, and people say, well, what if this time's different? What if the Fed? What if Ukraine? What if? It's different every time, folks. The circumstances around the market are always different. Have we had another great financial crisis? Did we have another 9/11? No, those were very different circumstances, the same as COVID was a different circumstance. You know what's not different? And why you have new all-time highs clustering in calendar years? Because human behavior is pretty darn constant, especially when it's dealing with the market prices. That's not different. You're talking about when you're looking at these studies, it's human behavior. And human behavior engaging with price action is very constant. Nonetheless, all right, made all-time, given the aforementioned analysis surrounding all-time highs clustering in calendar years, there has never been a calendar year that finished with just 17 all-time highs. Every time it has gone on to make at least one more new all-time high. Needless to say, the forward positivity rate by year-end 2024 is 100% in favor of yet another closing all-time high. Now, you've all been paying attention to the market. We've made successive new all-time highs this week. In fact, we now have 20. This should be updated to 20 all-time highs as of Thursday's close. 20. And here's the good news. Do you see any 20 here? No. The next number up to bat, 22. So historically, if somebody says, do you think the top has been made for the year? Right? I mean, we're already up 10% for the year. I get it. I get it. And we're going to get into that. History tells us no. History tells us the top has not probably been made. These are all about probabilities. The data gives you the probabilities. And historically, there's been a 0% probability that once you've made 20 new all-time highs in a calendar year, that was it. There's a 0% probability. People don't like this kind of stuff. They even laugh at it. Here was the tweet on March 16th last week. S&P 500 has made 17 all-time closing highs. There is a 100% probability that the top has not been achieved for the calendar year. Laugh out loud. I'm bookmarking this one. People laugh at this kind of stuff. What happened after that? New all-time highs. That's what happened after that. Is he laughing now? Who knows? But most of the time, people need to learn this stuff. The people that laugh are the people that are not going to learn. Let them shortchange their portfolios if they choose to do so. I just mentioned that we're up like almost 10% year to date as of yesterday's close. So Wednesday after the Federal Reserve, right? The FOMC meeting, we were up 55 trading days. Through the first 55 trading days of the year, we were up 9.5%. Most of the time, from the day 56 to the year end, most of the time, you went on to make more and more gains. These are the best 15 starts to a calendar year in history. The best 15. Usually you go on to make more gains. With that being said, we're talking about reading the data more closely, looking deeper than just what the headline is training your eyes to look at. What if we were up just between 9.5% and 12.1%? 0 times did the market go down from there through the year end. 0 times. So we're halting it right here. Now, if you've gained 12.5% or greater, there's been some bad spills for sure. But 9.5% to 12.1%, the forward positivity rate through the year end is 100%. There's no red here. Here's the other thing you want to look at. What was the worst return, right? From day 56 to year end, if you were between 9.5% and 12.1%, the worst return by the end of the year was 1.7%. Okay. Got something to work with still here, folks. Well, what if we correct 10% from here? Good. Because from that 10% bottom, you should rise 11.7%. At least 11.7%. Reading more. Don't let your eyes get trained on titles. Look deeper. There's a lot more here than meets the eye, as they say, as I say. All right, going back to our research report, I pulled this, as you can see from our screenshot here. I pulled this out of our September 2023. Within our September 2023, and after having already achieved our initial 2023 S&P 500 price target of 43.50, we updated our price target objective to include a year-end objective of 47.50. Again, for those of you who know your market history, you know this was achieved as well. We were one of the very few bulls. When it comes to sell-side strategist community, we were one of the few bulls out there last year from the beginning to the end and here in 2024. As we weigh the evidence, add up the tailwinds and headwinds, and recognize that Finom Group's 2023 S&P 500 price target of 43.75 was already achieved in June, we are prepared to outline our near-term price target objective and a new 2024 price target objective. And here's what we came up with for 2024. Assuming no recession, through the first half, here's details, right? It's in the details. How bullish are you, Seth? How accurate have you guys been at Finom Group? Assuming no recession through the first half of 2024 and estimating full year 2024 EPS of at least $250 per share, we target S&P 500 to achieve 5,200 by June, the first half of 2024. Now, for those of you who study the different strategists, the different institution price target, Goldman Sachs, Merrill Lynch, all the big names, right? You know that their price targets coming into the year, the median price target was 50.50 for this year. Now, you've seen them lift their price targets to 5,200, 5,400 recently, but that's their full year price target. We were specific. We said basically in the first half of 2024, we'd hit 5,200. We are literally the only firm that had a 5,200 price objective in the first half of 2024. Not year end, but the first half. Here it is. This was back in our beginning of the year. As a reminder, for our premium and our contributor members, we wanted to make sure that they knew where we still stood for calendar year 2024. In our first weekly macro market research report, we reiterated our call for the year, or for the first half of the year, I should say. Using all this data, all this supportive data, all of the verbiage, looking at numbers and numbers of different studies to come up with the most appropriate price target. It's the weight of the evidence approach, our proprietary data, third-party data. And there you have it. Our most bullish price target, an election year, historically does not prove as robust a year for the S&P 500 returns. And until rates relent, we think the upside to the PE ratio will be range-bound between 18 and 21. Right now, we're trading at almost 21 times. In the event rates and yields do relent, the Fed cuts, 10-year yield goes down, our more bullish price target objective for 2024 is 5,400. Now, since we've already reached our profit target objective for the first half of the year, in our future macro market research report, we will update our price target for the remainder of the year. It may be 5,400. It may only be 5,300. It could be 5,600. Again, If you're not a member, subscribe. You see all the work that goes into these numbers. All right, moving on. Bad breath, right? That's like just been the bearish mantra for the last year, all last year, right? It's just the Magnificent Seven driving the market returns. And early this year, it's kind of been the same thing. Now, there's no denying that breadth has caught up with price, okay? We've got new all-time highs on the NYSE advanced AD line, the S&P AD line, the Dow Industrials AD line. I mean, we got equal weight S&P 500 at all-time highs on its own right. We got mid caps, S&P 500, S&P, I think it's, sorry, 400. Yeah, 400, S&P 400 is at an all-time high. Its AD is at an all-time high. Now, this is a chart study of the week. Look at the date from Inside Finom Group's May 2023 research report. May 2023, our research report. Folks, when people were throwing out that breath crap last year, chart study of the week. All I did was cut and paste because I want you to see this, folks. I want you. Have we been here before? Have we had to listen to this garbage before coming out of a bear market, right? We listened to it all last year coming out of the 2022 bear market. We had to listen to the breath nonsense, didn't we? All last year. People are still holding on to that nonsense here in 2024. But have we been here before having to deal with the crap that the perma bears throw out? I'm going to show you something very interesting. Now, when we talked about this in our May research report, when we talked about this the first time, what did I show? This was coming out of the March 2009 bear market low. This is the equal weight S&P versus the cap weighted S&P. Look at the trend line. 12 months, 24 months, 28 months, give or take. All of a sudden, we broke that trend line. It was nasty. Fast forward. The ultimate bottom in the same performance ratio coming out of COVID was September. The September COVID performance ratio for equal weight versus the cap weighted S&P 500 index ETF. It bottomed, and then look, 28 months later, broke right through it. This is cyclical. History doesn't always repeat, but it often rhymes. Hence the title of this video, right? 28 months this go around, 28 months last go around. A lot of good stuff. Oh, the banks. It's different with the banks. The banks had already failed in 2000. No. There were bank failures in 2010. There were bank failures in 2011. There were bank failures in 2012. So in 2023, when we're listening to all this crap, right, and we had to deal with the SIVB bank failures and a couple others, that wasn't different either. Pretty much just par for the course coming out of a recession, folks. Yields were falling. Yields were falling late last year also. Late last year, yields just all of a sudden imploded. 10-year yield dropped 100 basis points or more. So let's fast forward to the present day. Okay. This is the equal weighted S&P 500 versus the cap weighted S&P 500. This is the performance ratio trend line of a 250-day rolling relative returns. And as you can see, equal weight is underperforming over this time period. You know, we're going from 2004 to the present day. Point being, look at today's trend line for the performance ratio of equal weight versus cap weight. We've never seen this steep of a fall and beyond the trend line. Here's a question. What if we were to stop right here? What if none of this existed? What if we were back in 2012? Wouldn't this look really bad on its own? Wouldn't it just look really bad, right? Like we could draw a straight line from the former low to this low right here. You don't know what's going to happen going forward. We're in 2012, folks. And recall where this chart is. This is going into 2012. Over here, 2011 through October. Out here is 2012, right? Looks bad, doesn't it? What if this is just supposed to happen? Happened before. What if it's supposed to happen? It's just part of the cycle. It looks bad, right? You throw this chart on Twitter, people get scared. They think breath is really bad. How can it be? The equal weight S&P 500 just made an all-time high on an absolute basis. Then how come this is happening? That's how strong the cap-weighted S&P 500 is. It's not the equal weight's fault that the cap-weighted S&P 500 is that much stronger. Can't do anything about that. Moving forward. Here's the other thing, because people say, well, the equal weighted index gives a point to every single stock. That's true. Here's what they don't tell you. It doesn't weigh each sector equally. Here's all the weighting of the different sectors in the equal weighted S&P 500. 13% for technology. The biggest weighting for the sector is industrials at almost 16%. So even the equal weight S&P 500 index is trying to pick winners for you. It's also why this happens. It has nothing to do with the individual stocks. It has everything to do with the sectors not exactly being equal weight. So let's fast forward to today, the present day. Again, here's 2010. Now remember, I cut you off in October. Was that the ultimate low in the performance ratio? Nope. It took another 10 months to make the all-time low there at that time. And then you had a pretty magnificent rally. So what am I going to show you next? Here's present day. Here's our present day from the COVID low to breaking the trend line in 28 months. And look at this. That was the low, right? That was the former low for this ratio after the 20-month break, 28-month break. Well, guess what? 8 months later, we've made a lower low. Remember, 10 months later, still making lower lows. Ultimate bottom came 10 months later. Maybe this is not the ultimate bottom because we're not 8 months in. 8 months from that initial bottom, here we are 8 months later. History's repeating. For all those people who are crying, howling at the moon, it's not different this time. It's almost identical to what happened coming out of the great financial crisis. What did I say atop this video? The circumstances are different. This isn't post, 2009 was post great financial crisis. 2020 to date is post the COVID crisis. The circumstances are different, but human behavior is playing out perfectly, again, with price action. To ignore this is basically to defy logic. Not doing your homework, really. All right, let's get into some nonsense, okay? We talked about colloquialisms, how markets just, people just throw stuff, and I don't care who it is. Marty's wig, I'm not going to pull any punches, folks. The great Marty's wig, don't fight the Fed, makes no sense. The context around that is when the Fed is hiking, usually the stock market goes down, usually. Especially, if they're fighting inflation. Don't fight the Fed. I'm supposed to ignore cheaper prices? If the market's going down, don't I want to buy low? What kind of garbage is that? Don't fight the Fed. Just sit on my hands? Don't do any... what is that? Oh, but don't say that publicly. It's the great Marty's wig. I don't see him in the pantheon of, the best world, investors ever. Don't fight the Fed. What am I? How is buying low fighting the Fed in the first place? With that being said, we only live once. Nope. It's the stupidest thing. Wrong. We only die once. We live every friggin' day. You're dealing with life on a daily basis. I mean, whoever said that, it means nothing. But again, it's catchy, and it just became this colloquialism. S&P 500 after extremes in fund manager sentiment. People think that, the sentiment is contrarian. It can only be contrarian. If sentiment is really low, you want to get bullish. Contrarian. If sentiment is really extremely high, you want to get bearish. That's not what history tells us. And this is based on the global, the Bank of America Research Global Fund Manager Survey. And we can see, the peaks in sentiment here. We had an 8% pullback, but then we rallied 40%. Here, this peak in February 13, nope, just kept rallying 40%. Here in 2017, 8% rally, then we had a 10% pullback, followed by another 14% rally. About 2021, we went on to make another 22% gain. There's a popular belief that the markets demonstrate a certain degree of mean reversion. While this has some truth, it's very impractical. There's really nothing you can do with that. And it's a dangerous belief system. It's dogma. Why? Well, such belief filters into other aspects of market dogma and investor behavior, more importantly. It basically fosters the idea that what goes up must come down, or bullish extremes equal bearish extremes. None of that has validity. None of that. It's not true. The chart above tells you that's not true. Bearish extremes do not equal bullish extremes and vice versa. Something else that we were supposed to understand, that I've been the one howling at the moon, right? We've heard that quantitative tightening leads to market declines. There's no truth to that whatsoever. We've been going through quantitative tightening now since June of 2022. I'm sorry, something about markets at all-time highs? Every time I hear that nonsense, that quantitative tightening equals less liquidity for the markets, which markets, right? They never say which markets. They just say markets. Bond market, equity market, they just say markets. And there's a reason for that. There's no, intermarket plumbing between the bond market and the equity market other than sentiment. Equities can't go up if yields are rising. Yields have been rising pretty much all year long. Something about all-time highs? Market colloquialisms, right? This was great. This is from the Lighthope Group's research. Old school measures of stock market liquidity, like money supply growth, have been extremely misleading during the current bull market. Money supply is M2. In fact, the NASDAQ composite made its bear market low in December 2022, just as year-over-year growth in M2 was turning negative for the first time since at least 1960. But I thought if money supply was going down, markets go down, there's less liquidity. No matter who I've asked in my 24 years of macro market analysis, nobody's ever been able to tell me the intra-market relationship between M2 and the S&P 500. Not a single person. Then why do they keep saying that? Well, because Merrill Lynch said it, because Morgan Stanley said it, and Goldman Sachs said it. And they can draw two lines on the chart that look like they're going in the same direction until they don't. Folks, you can put two lines on the chart and they look like they're, but doesn't mean one's causing the other, which we'll get into in a moment as well. All right. One of the first things we learned in this business was how sensitive the tech stocks in particular were to the money supply. It might be time to toss that 34-year-old bit of wisdom to the trash heap. Like, this is the light hole group saying the quiet stuff out loud. They're basically saying, that it's like gold is a hedge against inflation. Didn't work this time. Here's the reality. They've been saying that for 40 years. Why? Because you can get away with it. We haven't had a spike, like a material spike in inflation in 40 years. So it hasn't really been tested. Here's what I would ask you. How in the world is this block of gold supposed to help me fight inflation? Am I going to 7-Eleven to buy my Slurpee with a block of gold, a speck of gold, some gold dust? It makes no sense. It never did. It never made any sense. But it became dogma around Wall Street, and people just believed it till now that they, have been able to witness an inflation spike where gold was the worst performing asset class during that inflation regime. Now people know. Inflation and the unemployment rate, right? There's this belief that, again, Wall Street dogma, that if you have low unemployment, tight labor market, it leads to inflation. But as you can see, here's the unemployment rate in red. When it's going down, here's the annual CPI in blue. Is it going up? No, it's pretty much just going sideways and with dips, as the employment rate goes down. Again, employment rate goes down, pretty much nothing. You have high, you have low. They're not correlated. One is not causing the other. Here's another. Employment rate going lower, lower, lower. We got all the way down here at one point in the CPI. Pretty much just sideways thereafter. It's garbage. It's just Wall Street dogma. Put it on a chart. They're not correlated. Low unemployment does not lead to inflation. I'm sorry. All right, last but not least, as I said, you can put any two lines on a chart and they can look like they're trending in the same direction. That does not mean that one is causing the other. There's no correlation coefficient. It's kind of like ice cream sales and shark attacks. Far too many people confuse and conflate the concepts of correlation, coincidence, and causation. It may be because of alliterations, I don't know. Remember, ice cream sales do not cause shark attacks. Both ice cream sales and shark attacks increase when the weather is hot and sunny, but they are not caused by each other. They are caused by good weather with lots of people at the beach, both eating ice cream and having a swim in the sea. That's it. With that, I hope you enjoyed our latest video, and do be on the lookout for our next video as well as our next macro market research report. If you don't get our videos, if you don't get our research report, do consider joining phenomgroup.com. Take care, everybody. Have a great week.